The Relative Strength Index, or RSI, is an indicator that falls under the category of oscillators. It's an extremely simple indicator to use. RSI was created by Welles Wilder, who also created ATR, or Average True Range, Parabolic SAR, Stop and Reverse, and other well-known indicators. Oscillators are used to help determine when a currency pair is overbought or oversold. To say that a currency pair is overbought or oversold, we simply mean that the buying or selling pressure has run out of steam, making a reversal in price direction more likely. For example, if buying pressure has run out of steam, we can expect prices to fall sometime in the near future. Awareness of this situation can help us better time a good selling opportunity. Alternatively, if selling pressure has run out of steam, we can expect prices to rise sometime in the near future. Awareness of this situation can help us better time a good buying opportunity. RSI can thus be used to help locate these situations, helping traders locate better entry and exit prices. Let's talk about how to use the RSI indicator in your trading. The situation you want to look for in a potential buying opportunity is to note a pullback down to support when the market is in an uptrend. A potential selling opportunity is a rally up to resistance when the market is in a downtrend. While many traders can identify a move against the trend, they do have a tough time determining support and resistance, or the entry point and initial stop level on a trade. This is where the use of a technical indicator like RSI can be of great help. Since RSI is an oscillator, it's plotted with values between 0 and 100. The value of 100 is considered overbought, with the likely chance of a reversal to the downside. The value of 0 is considered oversold, with the likely chance of a reversal to the upside. Traders will further identify any reading of 70 or higher as overbought, and any reading of 30 or below as oversold. So the thought process goes, when the market moves to 70 or above, the market is likely to reverse to the downside, and when the market moves down to 30 or below, the market is likely to reverse to the upside. But markets are known to stay overbought and oversold for long periods of time. This is really what identifies a strong trending move. So we don't want to look for sells when the market is in a strong move up, or to look for buys when the market is in a strong move down. So the key to using this indicator, like all other indicators, is to first identify the direction of the trend. When the market is in an uptrend, we want to note those periods that the RSI moves down to oversold as a potential buying opportunity. We also want to look to sell when the market is in an uptrend and the RSI moves up to an overbought level. To increase the likelihood of catching a reversal, traders will typically wait for the market to move back down to below 70 after it's been above 70, or back above 30 after it's been below 30. That would be the point used as an entry into the trade. This chart shows a market that is in a strong downtrend and then makes a strong counter move to the upside. The counter trend move causes the RSI to move into overbought territory. After sustaining this counter trend move for some time, we see that the RSI moves to below 70 from above 70. This is a classic selling opportunity. We simply look for the move to below 70 to signal our sell entry. We expect this move to signal a continuation in the original trend. It's important to wait for the candle to close on the chart to make sure that the move has been confirmed. A move to below 70 can be noted in the middle of a candle, but change before the candle can close, so wait for confirmation before acting. Since we are entering into the trade after the reversal, we can identify the high as resistance and use that level for our initial protective stop level. Traders will place their protective buy stop a few pips above the high, with the thought process being that if the market moves up to a new high, we don't want to be in a sell trade. Now let's take a look at a buy setup. Here we see the market in a strong uptrend. So we want to note when the RSI moves down to the oversold condition, which is below 30. Once again, we look for the RSI to move back above 30 to signal the buy entry. We wait for the candle to close in order to confirm that the move back above 30 has taken place. We then buy at the open of the next candle and place our protective sell stop a few pips lower than the low. There will be times when we buy or sell and the market will move to stop us out of the trade. After all, markets can do what they want when they want. A big order may come into the market that temporarily pushes the market down to a new low after we bought or to a new high after we sold. But the RSI can also give us a second chance to enter into the trade if we wish. Let's look at an example. Here we note that the trend was up, so we bought on the move back above 30 by the RSI. The market started to rally, but then some selling pressure temporarily pushed the market down to a new low. However, note that the RSI did not move down to a new low like the market did. This is known as positive divergence. It is simply when the market moves down to a new low, but the RSI does not. This is a bullish signal and gives the trader an opportunity to enter into a trade once again. They simply note the second move above 30 and treat it as a new buying opportunity. This means they place their protective sell stop below the second low and look for continued buying interest to push the market up. You can see here that another example of this happened on the same pair about a month later. Here is an example of a second selling opportunity. Let's zoom in close on the highlighted section to see in detail how the trade would have played out. The first move below 70 was confirmed, with the sell being at the open of the next candle. But the market moved up to a new short-term high as buying interest came into the market. Although the market moved up to a new high, stopping out the first trade, the RSI printed a lower high. This is negative divergence and signals an opportunity to enter into a second sell position. Traders will simply enter as the second move to below 70 is confirmed and place their protective buy stop above the higher high. And if we zoom back out to a longer term picture of this trade, you can see how the second entry turned out to be a pretty good one. If we closed out as the RSI moved closer to the 30 level, signaling an oversold condition, a profit of around 300 pips was possible in this example. While this indicator can work on any time frame, like all technical analysis, the daily chart will typically offer the better trading opportunities, with the shorter term charts offering more opportunities. So it's up to each trader to find the balance between solid opportunities and the number of trades they wish to take advantage of in their approach. But the key is, as always, to trade with the trend and not against it. Before closing, we'd like to briefly discuss the input values used with the RSI indicator for those who might be interested. When pulling up RSI on a chart, the charting application will prompt you to select how many periods you would like to include in your study. The most commonly used number is 14, and most traders do not alter the default setting. All of the examples used in this video used 14 periods. Some traders do use 9 or 25 periods instead of the standard 14. Of course, increasing the number of periods will decrease the number of signals, but increase the reliability of those signals. Decreasing the number of inputs would have the opposite effect. With RSI, there are times when the default value of 14 does not signal any overbought or oversold conditions, so using a lower value may be necessary to signal any trading opportunities. To learn more about how to use RSI in your trading, make sure to utilize all of the great resources available at DailyFX. DailyFX offers a wealth of material including daily news and analysis on the FX markets, as well as some great forums where users can discuss in-depth concepts and trading ideas, just like we've done here today. Additionally, for those who are interested in really taking trading seriously, enroll in one of our online courses today. We've taught more than 25,000 students about trading FX and would like the opportunity to work with you too. Thanks for watching and good luck with your trading.